Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today, I'll be talking about finding and closing deals in today's environment. Hey, everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
We just closed our first deal in a year, Cabo del Sol, soon to be renamed Icon on Midvale. It's our second deal in 2 years, so deal flow continues to remain very slow. We've made some offers on opportunities in a few markets, but mostly what we are seeing was either brand new and too costly, too old, or an opportunity that had way too much hair on it. So all you can do is keep doing the work and remain patient. We do have another property under contract right now. It's a sister property of Cabo's, which is less than a mile away. We'll run it as one property, but two separate entities because we'll have some different investors for each. This allows for nice economies of scale. I can get one high-quality property manager, one assistant manager, and one leasing agent to split between the two properties versus two property managers and two assistant managers. So I'll save some money there. And we'll also do it on the maintenance side with one supervisor and two maintenance techs. It's not a big lift like we've typically done. We've averaged a 40% bump in NOI in the first 12 months of owning the rest of our properties. This is more of a cash flow play with a high quality asset. It will be our youngest property in our portfolio as it was built in 1999. It's 136 units. 78% consisting of 2 and 3 bedrooms. We'll renovate the remaining units, update the landscaping, add a barbecue area for residents, and have some better operational efficiencies. It's in Tucson, which is a market we know well. This will be our 10th deal there. And we have 2 properties close by these properties. We like to focus on a few markets so we can be experts in those markets. It's really hard to be good when you have properties all over the country. You need some density. On the capital side, it was much, much easier than last year. Last year, it was super slow raising money until we hit January and February of 2024. This year, we were way over soft committed. So even though we didn't have all the money in right away, we felt good about it. We were able to operate or work from a place of strength or confidence, if you will, versus a place of anxiety. Obviously, having a good deal and believing in it, you have a feeling you're going to get there, like we did with our previous deal. But it's nice to do that without the stress of waiting for the money to come in. So I think sentiment really changed. Last year, it was very doom and gloom, particularly in the news cycle. But this year, the stock market and Bitcoin have been doing very well. The focus was really more on with the presidential election. Interest rates have been moving down, which gives people a sense of things are moving in the right direction. Though Treasury rates have been moving all over the place, which if you're watching them closely, it'll certainly give you some whiplash. NMHC, which is the National Multifamily Housing Conference, held every year at the end of January, will be here shortly. So deal flow should pick up then, but I'm not expecting a ton of deals, but definitely an uptick. Some operators are still sitting on the sidelines, holding their deals until cap rates compress. If they do compress, who knows? So they could try to sell it at a profit versus a loss. But many of these deals are highly leveraged, and covering debt service will be a struggle for some. So I expect a bunch of these to be coming to the market. Not a tsunami of distressed debt, which I think a lot of people were hoping for. But a consistent deal flow. There'll be some opportunities out there, but not a ton on the cheap. All you can do is do your due diligence, be active, so you can get those deals when they are put out there. Ask any operator, and he or she will say it's been a tough year. Certainly, it's been tough for me. You've had lower income with little rent growth to most likely negative rent growth. Higher delinquency, concessions, lower occupancy, higher insurance costs, even in an area like Tucson where we don't have those natural disasters. The increases have been, crazy high. And certainly you've had an increase in other expenses as well. I see some operators out there that have changed asset classes or their roles because they're just struggling, and I get it. It was easy when rent growth was growing at a crazy rate time and time again, and capital was easy to raise, and debt was easy to come by. However, I'm a big believer that there's opportunity out there in any economic cycle and submarket, as long as you know it very well. This is a real business, and if you run it as such, then you have a good chance of succeeding. When you don't put in the work and build the infrastructure for your company, you're putting yourself at a disadvantage. Here's a public service announcement. If you are a passive investor, don't chase bonus depreciation at the end of the year. You're much better off getting into a good deal with less depreciation versus a bad one, because you may not see your money back or make a lot less. While I'm on my soapbox, don't chase IRR as well. If it looks too good to be true, perhaps it is. You're much better off investing with a seasoned operator who knows how to get the best out of their property and navigate through tough times. This is what can make or break a deal. Trust me, I've made some mistakes investing in others passively, and that's why I wrote Invest Smart, Spotting Red Flags in Real Estate Syndications, so that others can learn from the 100 plus investments my team and I have made. A lot of people are feeling some pain investing with good and bad operators over the last few years. Definitely more so with the bad operators, or the ones that were just way too aggressive. Like any business, there are good times and bad, even for the best operators. The good ones persevere and find solutions. The bad ones typically never come back. Well, that's all I have for today. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.